There is a number I want you to hold in your mind before I say a single other word. $114. That is what a barrel of Brent crude oil costs this week. Not last year, not during the Gulf War, not during the Arab oil embargo of 1973. This week, right now. And the single most powerful financial institution in the history of the modern world, the Federal Reserve of the United States of America, is sitting completely still, frozen, unable to act, because every move it makes from this moment forward will hurt someone catastrophically. That is not rhetoric, that is mathematics. And I am going to walk you through that mathematics the same way I would walk a young student through it. Slowly, plainly, and without the comfortable fog that television anchors and political spokesmen spray over every crisis to keep you calm. I do not want you calm right now. I want you to understand. Because understanding is the only thing that separates the people who protect their financial lives in moments like this from the people who watch their financial lives dissolve without ever knowing why. I call this the dual mandate prison, and the Iran war just built the walls. Let me start from the beginning, the way a good teacher always starts. There is a building on Constitution Avenue in Washington, D.C. It has white marble columns. It has the words Federal Reserve carved above the entrance. Inside that building, 12 people sit around a table every 6 weeks and make the single most consequential economic decision on earth. They set the interest rate that determines how much it costs to borrow money in the world's largest economy. That rate flows through every mortgage payment, every car loan, every business credit line, every corporate bond, every government treasury, every credit card balance held by every American family trying to make it to the end of the month. 12 people, one table, the whole weight of the American economy resting on that decision. And right now, for the first time since the 1970s, those 12 people are trapped in a position where every option available to them makes the situation worse. Not harder, not complicated, worse. The Federal Reserve has a dual mandate, 2 jobs it is legally required to perform simultaneously: keep inflation near 2%, keep employment high. Those 2 jobs are designed to pull in opposite directions in normal times, which gives the Fed room to maneuver. When employment falls, the Fed cuts rates to stimulate growth. When inflation rises, the Fed raises rates to cool spending. The system was engineered for a world where you fight one enemy at a time. Iran just sent both enemies through the door simultaneously. Here is the exact moment the trap closed. On February 28, 2026, the United States and Israel launched military operations against Iran. Within 4 days, Iran closed the Strait of Hormuz, the narrow waterway between Iran and Oman, through which 20% of the entire world's oil supply must pass. 20% of global oil, gone, not rerouted, not delayed, gone. The Dallas Federal Reserve Bank published a formal analysis this month stating that if the strait remains closed through June of 2026, global economic growth will fall by an annualized 2.9 percentage points in the second quarter alone. If the closure extends to 3 quarters, the Dallas Fed's own models show oil prices reaching $132 per barrel and the impact on growth remaining negative through the end of the year. We are currently on day 27 of that closure. Oil is at $114 on the international benchmark. Goldman Sachs issued a statement this week saying these elevated prices could persist through 2027, not through April, through 2027. And Jerome Powell, the current Federal Reserve Chairman, stood at a press conference this month and said something that every American family should have heard, but almost none did. He said, and I am using his exact words because they deserve to be heard exactly, "The thing I really want to emphasize is that nobody knows. The economic effects could be bigger, they could be smaller, they could be much smaller or much bigger. We just do not know." That is the chairman of the Federal Reserve, the most powerful central banker on earth, saying he does not know. That is not humility. That is the honest description of a person who is trapped. Now I want to teach you about what I call the stagflation trap, because this is the concept that determines everything that happens next to the American economy and to your personal finances. Stagflation is not a complicated word. It means 2 things happening at the same time that the textbooks say should not happen at the same time. Inflation rising, growth falling, prices going up while jobs disappear. The economic system was not designed to handle both simultaneously. because the medicine for one is the poison for the other. If the Federal Reserve cuts interest rates to save the jobs, and remember, the United States economy already lost 92,000 jobs last month before this war fully priced into the labor market. Cutting rates puts fuel on the inflation fire. Cheaper borrowing means more spending. More spending into a world of disrupted oil supply and fractured shipping lanes means higher prices. The dollar weakens. Every barrel of oil already at $114 gets more expensive in dollar terms. Every imported good gets more expensive. And 5 years after the post-COVID inflation crisis taught every American family what it physically feels like to watch their grocery bills and rent and gas receipts climb month after month without stopping, the Federal Reserve will have chosen to let it happen again. On the other hand, if the Fed holds rates or raises them to fight the inflation, and inflation was already running at 2.4% above their 2% target before the first missile flew, it abandons the jobs entirely. The 92,000 families who lost employment get no relief. The businesses already squeezed by tariffs and slowing demand get squeezed harder. Mortgages stay expensive. Car loans stay expensive. The housing market, already frozen by years of elevated rates, stays frozen. The economy that this administration promised to fix gets more broken, and the Fed owns all of it. Mohamed El-Erian, one of the most respected macroeconomic voices alive, said it plainly this month in Fortune magazine. Stagflation risk is higher because of limited policy flexibility from the Federal Reserve. Limited. That is the word a careful economist uses when he means the Federal Reserve has almost no room to move. Let me show you the physics of what is actually happening to prices right now, what I call the Hormuz math, because this is where the abstract becomes personal and the geopolitical becomes domestic. Every $10 increase in the price of oil adds approximately 0.2 percentage points to the inflation rate. Oil has risen by more than $40 since this war began. Do that arithmetic. The Producer Price Index, which measures what businesses pay for inputs before those costs reach the consumer, was already running at 3.6% year over year when this crisis started. The Producer Price Index is not what you pay at the grocery store today. It is what you will pay at the grocery store in 60 to 90 days, because that is how long it takes for the cost a manufacturer pays for energy and shipping to travel through the supply chain and arrive on a shelf with a new price tag. Rice exports are stuck at Indian ports. Fertilizer prices are spiking because fertilizer is made from natural gas, and European natural gas prices nearly doubled in a single week at the start of this conflict. Shipping routes that pass through the Strait of Hormuz are now navigating around the Cape of Good Hope at the southern tip of Africa, adding 2 to 3 weeks to every voyage, which is 2 to 3 weeks of additional crew wages, fuel costs, insurance premiums, and financing charges that every shipping company in the world will pass directly to the importers, then the retailers, then you. Capital Economics has stated that inflation will rise by 0.5 percentage point in most Asian economies if oil stays at current levels. Hartford Funds published a formal note this month warning that fewer Federal Reserve rate cuts are now on the table and that the risk of inflation pass-through is real and present. Former Treasury Secretary Janet Yellen said the situation puts the Fed even more on hold, more reluctant to cut rates than they were before any of this happened. These are not fringe voices. These are the most credentialed economic minds in the world, and they are all saying the same thing in different language. The trap is closed, the math is running, and the consequences are arriving at American kitchen tables in 60 to 90 days, whether anyone is ready or not. Now I need to tell you about what I call the Warsh paradox, because this is where the economic crisis becomes a political one, and the political one becomes something that may define the next 3 years of American financial life. Sitting in the Senate confirmation queue right now is the man President Trump has chosen to replace Jerome Powell as chairman of the Federal Reserve when Powell's term ends in May. His name is Kevin Warsh. And Kevin Warsh was chosen for one reason above all others. He believes interest rates should be lower than they currently are, and he has said so publicly. Trump wants cheaper mortgages. Trump wants cheaper business borrowing. Trump wants an affordability story he can run on in the midterm elections. Warsh was chosen to deliver that story. But Warsh's intellectual framework for monetary policy has a specific characteristic that the Iran war has now turned into a serious problem. His approach treats energy price spikes as temporary pass-through events that do not require a monetary policy response because historically they fade. In a normal geopolitical flare-up, a skirmish, a weekend of missiles, a ceasefire in 2 weeks, that framework is intellectually defensible. This is not a normal geopolitical flare-up. This is the Strait of Hormuz closed for 27 days and counting. This is Brent crude at $114, with Goldman Sachs modeling prices through 2027. This is the Dallas Federal Reserve, the Fed's own research arm, publishing scenarios where oil reaches $132 per barrel if the closure extends another 2 quarters. Neil Kashkari, the president of the Minneapolis Federal Reserve, said explicitly this month, and I am quoting precisely, "I had a lot of confidence up until a couple of days ago. Now we need to get a lot more data in." Kashkari had penciled in 1 rate cut for all of 2026. Now he is not sure even that one survives. Jerome Powell made the situation even more difficult for Warsh when the Fed released its latest summary of economic projections this month, raising its inflation forecast, scaling back its rate cut expectations to just 1 for the remainder of 2026, and citing not only oil prices, but the inflationary effects of tariffs as compounding factors. Warsh needs a majority of the 12-person committee to support any rate cut. Powell just told him in the clearest possible institutional language, that majority does not exist right now. CNBC reported this week that every day oil stays elevated, every 1/10 of a percentage point inflation climbs above 2%. Those votes get harder to collect. The man chosen to lower rates cannot lower rates. The paradox has become the policy. I want to pause here because I know exactly what some of you are thinking. You are thinking, Warren, this is a geopolitical problem, not a financial one. Wars end, oil spikes fade, the strait will reopen. And you are not wrong to think that. If this conflict ends in the next 2 weeks, if the strait reopens by April 1st, if oil retreats to $80 and the supply chain disruption proves temporary, the Federal Reserve's room to maneuver returns. Inflation does not spiral. The stagflation risk fades. I understand that scenario. But let me tell you what I have learned across 7 decades of watching markets and governments interact. The optimistic scenario is not the one you should build your financial life around. You build your financial life around the realistic scenario, which means accounting for what happens if the war does not end in 2 weeks. CNBC reported this week that energy analysts are warning that if the situation extends beyond April 1st, it could lead to a significant revaluation of oil prices, potentially pushing WTI well above $100 and raising concerns about shortages, particularly in Asia. South Korea's stock market already suffered its largest single-day decline since 2008. Thailand's stock exchange imposed trading curbs after an 8% drop in a single session. Bloomberg Economics described the Federal Reserve's position with one word: impossible. Not difficult, impossible. Stuck between a war pushing inflation higher and a president demanding lower interest rates. I have been in business long enough to respect the word impossible when serious economists apply it to serious institutions. Let me now give you the historical weight that this moment deserves, because history is the only honest teacher economics has ever had. The last time America faced a genuine stagflation crisis was the 1970s. Oil embargo of 1973, supply shock, inflation spiraling to 13%, unemployment at 10%, a Federal Reserve that tried to fight both simultaneously and failed. It took Paul Volcker, appointed Fed chairman in 1979, raising interest rates to 20% to finally break the inflationary spiral. 20%. Think about what a 20% interest rate means for a mortgage. Think about what it means for a car loan, for a small business line of credit. Volcker's medicine worked. Inflation came down. But the cure produced the worst recession since the Great Depression. That is the historical precedent sitting on the table in the marble building on Constitution Avenue right now. That is what the 12 people are thinking about when they look at oil at $114, at inflation above target for 5 consecutive years, at a jobs market already shedding 92,000 positions a month, and at a geopolitical crisis with no defined end date. Joe Brusuelas, the chief economist at RSM, said this month, and the word he used was present tense, not hypothetical. The risk of stagflation permeates, not might permeate, permeates, right now, today. The 1970s comparison is no longer a fringe academic discussion. It is the framework being used by the Federal Reserve's own economists. So let me tell you what this means for you. Not for the market, not for GDP abstractions, for you. Gas is over $3 nationally and rising with every week the strait stays closed. The food prices arriving on shelves in 60 to 90 days will reflect the fertilizer spike, the shipping rerouting, the rice stuck at Indian ports, the energy costs baked into every product that moved through the Gulf before February 28th. If you carry a variable rate mortgage, it will not get cheaper this year. If you were waiting for interest rates to fall before buying a home, that timeline just extended. If your employer is in manufacturing, in shipping, in any industry that touches global supply chains, watch the earnings calls over the next 2 quarters carefully, because the input cost increases are already locked in, and they will show up in hiring decisions. The families who understand what the Hormuz math means for domestic prices in the next 90 days are the families who prepare. The families who wait for the television to explain it will prepare too late. I want to end the way I always end, with time, because time is the only currency that no amount of money can repurchase. Imagine you are 80 years old. You are sitting quietly somewhere. You cannot renegotiate the financial decisions you made in March of 2026. You look back at this specific month, when the Strait of Hormuz was closed, when oil was at $114 and rising, when the Federal Reserve had publicly scaled back to 1 rate cut for the entire year, when Goldman Sachs had extended its oil price forecast through 2027, when the Dallas Federal Reserve had published formal modeling showing GDP contractions and oil at $132 in their extended closure scenarios. And you ask yourself the question that only honesty can answer. Did I treat this moment as a temporary news story? Did I wait for the crisis to resolve itself before adjusting anything? Or did I understand that the mathematics of a closed strait, a frozen Federal Reserve, and an inflation pipeline already running at 3.6% in the producer channel were not theoretical problems? They were practical ones, already in motion, already priced into the goods arriving at grocery stores, already locked into the rate decisions that will govern mortgage costs and car loans and business borrowing for the next 12 months. I have built everything I have on one principle: not intelligence, not connections, not luck, respect for mathematics. Mathematics does not care about optimism. It does not respond to political messaging. It does not pause for elections or ceasefire negotiations or truth social posts. It runs on its own timeline, in its own direction, at its own speed. Right now, the mathematics of this crisis are running clearly and in one direction. The Strait of Hormuz carries 20% of global oil. It is closed. Oil at $114 means inflation. Inflation above 2% means the Federal Reserve cannot cut. A Federal Reserve that cannot cut means mortgages stay high, jobs stay scarce, growth stays slow, and the stagflation that Mohamed El-Erian warned about and that Joe Brusuelas said is already here continues to compound quietly inside the economy, the same way water compounds quietly inside a wall long before the damage is visible. The missiles are flying in the Gulf. The economic shrapnel is already past the perimeter. There is no THAAD system for stagflation. There is no interceptor missile for a Federal Reserve that cannot move. There is only preparation, discipline, and the willingness to understand what is happening before the television tells you it already happened. The door to the cage is open. The cage in this moment is the comfortable belief that the Federal Reserve will figure it out, that the war will end quickly, that the mathematics will somehow arrange themselves favorably, because they always have before. They have not always arranged themselves favorably. Ask anyone who held stocks through the Volcker recession. Ask anyone who held a variable rate mortgage in 1980. The door is open, but walking through it requires admitting that this time, the 12 people around the table in the marble building on Constitution Avenue are not in control of the outcome. The strait is, and the strait is still closed.